Hi everyone. Haven't been here in a while, but good to see y'all again for December 6th, 2024, where the future starts today. Both jobs reports for Canada and the US came out for November. I'm not only going to give my quick thoughts on both reports, but also the underlying environment when it comes to rate cuts, because this is something I kind of covered earlier in the year, but obviously not doing as many videos as I probably should lately. It's something I think we need to rehash here, in my opinion, considering events that happened in November. But, anyways, I'll just go over Canada here pretty quick. This headline here from Bloomberg pretty much explains it all. Yeah, we gained jobs, but the unemployment rate went up again, which has been for almost 2 years now. And by the way, it's becoming an issue now in the US they're looking at. More on that in a second. But again, any jobs report where 90% of the jobs gained are government jobs, I'm sorry, I just can't take seriously. Central bank wise, I don't think they're actually going to care, honestly. But again, we'll go over all that here in a second. Now for the US. Yeah, as you can see here, quote unquote better than expected. Unemployment, though, as I mentioned previously, is ticking higher now and should get all of yours attention, if it hasn't since the first quarter of 2023 when I started reporting it. But anyways, again here, biggest job gains. 2 of the 3 sectors are healthcare and government. You know, what does that say? They were upwardly revised, though, the previous 2 reports, which is something that central banks do look at, funny enough. And regardless of whether it's an indicator or not, again, I'll let y'all be the judge of that. Nonetheless, yeah, they're predicting rate cuts. I think anything jumbo is out of the question at this point for another reason here. Show this quick. This is unemployment since the beginning of 23. Much like Canada and most places around the world, nice upward trend. But yeah, as far as the rate cuts go, a month ago, any big chance we had of more accelerated, more jumbo rate cuts, I think was taken out of the question because of the election. I did a short back in February about this, where I talked about elections being the biggest dynamic when it comes to rate cuts. And no matter what the data tells me today, or what any banker on TV or the internet tells me today, I'm still holding by this principle. Because let's be honest, they didn't want Trump winning. Okay? Whether you like the guy, whether you hate the guy, for my analysis here, it's irrelevant. They did not want him to win. And they were cutting rates as fast as they possibly could to try and get the economy back up, because they were desperate to show a good economy, good favorable job rating, yada, 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 to give him the lowest possible chance to win. And he won. And if you notice, a lot of the words coming out of the Federal Reserve lately, under their breath, I guarantee you they're saying the same thing. Okay? You can go on it all day about how Trump is a real estate guy, and real estate has benefited more from lower interest rates in the last 15 years than any other industry. You'll be 100% right here. But the fact of the matter is, anything that happens with rates here in the short term, and over the previous 6 to 9 months before this, let's face it, it was all political. Y'all ain't gonna like me for saying this, but you know me. I just say what I actually think. I say what I actually believe. And I still believe that. So in my opinion, yeah, the markets have gotten their hopes up today because of the unemployment rate going up, that they're going to see more accelerated rate cuts. I'm more than happy to take the other side here. And again, none of the reasons are economic in nature. So yeah, just going to go ahead and say that. Whether you agree or disagree, let me know in the comments down below. And as always, like, share, and subscribe. See y'all later.